We are now busy with step 3. We need to determine the transaction price. Now, what is the transaction price? Guys, this is the amount that our entity expects to receive from our customer. Now, if you think about this, and this is going to be a little bit of oversharing, I don't know about you ladies, but I hate fitting in a fitting room. I think there's something wrong with those mirrors, definitely. So I will buy something, I will fit at home, and I will return. And then they need to pay me back. Therefore, IFRS 15 indicates to us that we may recognize a refund liability. And this is why it's very important. The expect. How much does the entity expect will they receive from that transaction? Now, there's going to be 4 very important aspects that we need to look at. The one is that some of these transaction prices can be variable. It can include financing components. It can be non-cash items. And then there can be considerations payable to a customer. Now guys, just briefly, considerations payable to a customer. This will normally be loyalty points and all of those cards that actually just fill up our purse. I'm going to make use of the notes and work through the principles. Remember, you can add all of this on your page. The transaction price, we have indicated that this is the consideration expected. What is important, guys, is when there is amounts collected on behalf of third parties, this will be excluded. If you are a third party, you're an agent. And there is a paragraph that deals with this in IFRS 15. We will look at this. Now, these considerations can either be 1, fixed amounts, then it is easy to recognize our revenue, or 2, variable amounts, or 3, both. Now we need to look at these 4 aspects. The one is dealing with our variable considerations. 2, if there is financing components included in the contract. 3, non-cash considerations. And 4, a consideration payable to the customer. Variable consideration. Now, the first question that you need to ask yourself is the consideration variable? If your answer is yes, you need to know that you will have to estimate the amount to be used. And this can either be based on expected value or most likely amount. Now, what is the difference? Let's look at a basic example. If we refer to our expected value, this is the sum of probability weighted amounts in a range of possible consideration amounts. Therefore, guys, if we have in a contract or a scenario, for example, that there is a 10% possibility that 2 million will be paid, then there is a 20% possibility that 2.2 million will be paid, or a 30% possibility that our customer will pay 2.5 million. If we weigh this, 10% of the 2 million will be 200,000. 20% of the 2.2 million will be 440,000, and 30% will be an amount of 750,000. Therefore, the estimate revenue that we may recognize will be 1,390,000. Compared to our most likely amount, this will be the single most likely outcome of the contract. Now guys, again, professional judgment. If, for example, we have indicated that if the profit exceeds 1 million, all our regular customers will receive a 5% discount. Remember, regular customers that will receive a 5% discount that we need to account for. What is the possibility of this happening? This can either be yes or no. But how do we estimate this transaction? What is the most likely possibility? Guys, do you see that you will have to use your professional judgment in a theory question like this. Now, we are still busy with our first question. Is the consideration variable? If the answer is yes, you need to estimate the amount. Next question. You need to determine that portion, if any, for which it is highly probable. Now, let's just quickly talk about this highly probable. If we think about probable, what is the definition, or how do we explain probable? It should be more likely than not. Therefore, important, guys, more likely than not. Okay. Now, we are referring to highly probable. Therefore, more than probable. This is one higher, that the revenue should not be reversed. Okay. Now, let's just refer back to this block. Determine that portion for which it is highly probable that a significant reversal will not occur subsequently. Now, I'm going to explain it to you as follows. First step, we need to determine and estimate what is our revenue amount that we can recognize. Step number 1, based on expected value method or most likely amount. Step number 2, we need to determine what is the amount that we will have to refund, pay back to our customer. And this amount we need to take out and deduct. And the remaining balance will then be our transaction price that we can recognize. Therefore, guys, number 2, determine that portion for which it is highly probable that a significant reversal will not occur subsequently. And this will then be our transaction price. This is the amount that we expect to receive that we will not reverse. And we may include this in our transaction price. Now, they've included a few examples, and it is important that you just briefly scan through this for me. Discounts, rebates, refunds, and so forth, guys. And we have included examples in our lecture examples. Now, let's talk about refund liabilities. And this is an important one. First, if we look at the definition of a liability and you refer back to your conceptual framework, you will remember that this is a present obligation due to a past event. 3, that will lead to future economic benefits flowing out of our entity. Now, guys, when we think about our refund liabilities, what is this? This is when the entity receives a consideration from a customer and expects to refund some or all of the consideration. Therefore, guys, we need to recognize a refund liability for the possibility of that obligation that we need to pay. And we need to measure this at the amount of consideration received to which the entity does not expect to be entitled. Now, guys, this is a little bit difficult though, hey? How do we know what is the portion that the entity expects not to be entitled to? And then they indicate to us that we need to update this at the end of each reporting period. I want to discuss 2 examples with you. Our first example, we have a customer. We've recognized sales to the value of 100,000, and we expect that we will have to pay our customer 20% back, returns. What will our journal entry be? We will debit bank if this is a cash sale with 100,000. We will credit our revenue in our profit and loss with 80,000, and we will credit our refund liability account. Now, our next scenario, we recognized sales to the value of 100,000, and we indicate to our customer that if they pay us within 30 days, they will receive discount of 20%. Now, guys, how do we know if they are going to pay us within 30 days? We don't know. Now, what is our journal entry? We will debit our receivables with 100,000. We will credit our revenue with 100,000. How do we account for this 20% discount? If they did pay us within 30 days, and it is highly probable, we will have to debit our revenue, and our revenue will decrease with the 20,000. What account do we credit? We will credit our allowance for discounts. And this is an important thing, guys. Our allowance for discount is a negative asset account. Therefore, you will not see this in your statement of financial position. This will be netted off against your receivables. And you need to be able to identify the difference between a refund liability and an allowance for discount. Now let's refer back to our notes. There is certain contracts where the entity transfers control to the customer and provide the customer with a right of return. Now, what does this mean? If we have a customer that purchased distinct goods or services from our entity provides the goods or services and control transferred. But our entity provides a right of return in that contract. Therefore, this means that our customer has the right to return that specific goods or services to the entity. Now, IFRS 15 distinguish between two differences. The one is where the return of goods are not defective, and the second where the return of goods are defective, and this we will call warranties. Now, when we look at the return are not defective, our goods, the options normally will be where the entity provides the option to our customer to return the goods and receive 1, a refund, 2, they can replace the product, or 3, they can credit the customer's account. Now guys, it is important that you then know that if there is such an example, that you will have to recognize revenue from this transaction, you will have to recognize a refund liability, and important, your cost of sales and your inventory account, and now the additional right of return asset account. Why? They indicate to us that the entity provides the customer with a right of return. Therefore, our customer has the right to return that asset back to the entity. And we therefore have to recognize our right of return asset account. Therefore, what will our journal entry then be? We will have to debit our bank if this is a cash sale, and credit our revenue account, and credit our refund liability account. Remember, this is the amount that the entity expects to pay back to our customer. Therefore, this is the amount that the entity will not receive as revenue. And then we have to debit our cost of sales, credit our inventory, and important guys, we now need to recognize a right of return asset account. And that amount that we recognize should be the carrying amount of the product less the expected costs that will be incurred to recover the product from the customer. Therefore, guys, this will be our carrying amount minus any costs to collect that product from our customer. You will remember that you will have to reassess at the end of each reporting period what is your refund liability amount, and guys, the same with your right of return asset. At the end of each reporting period, you need to update the amount to ensure that this is the most recent values. Now, when you look at the notes, guys, we have discussed majority of this. The only thing that I want to discuss with you is where we have a customer that exchange one product for another, for example, due to size. Guys, this is not the right to return asset account. This will not be included in our returns for applying this standard because it lacks commercial substance. Again, when we think about commercial substance, this is where a transaction and changes to the transaction has an effect on our future economic benefits. Therefore, if a customer exchanges a t-shirt due to size for the exact same t-shirt, this will not be part of this standard.